Economists are weighing in on expectations ahead of the latest South African Reserve Bank's Monetary Policy Committee meeting. Outcomes expected later today. The key focus is the decision on the interest rate, this time around amid continued efforts to fight high inflation, which has regressed to 7%. Economist at Absa, Maluleke, joins us for this conversation. Thank you so much for your time, Miyelani. Much of the consensus is an increase by 25 basis points to the interest rate. Is that what the market is expecting?
Well, it really is, and it's also exactly what we as Absa CIB expect from the MPC this afternoon. I think, talk of the MPC has probably started to make a lot of South Africans very nervous, right? We have been in this hiking cycle for a very long time now. We've seen the repo rate go up from 3.5% in November 2021 to the 7.25% that it's at right now. We are expecting that they are going to increase the repo rate again by 25 basis points this afternoon, which would mean that the repo rate goes to 7.5% and the prime interest rate goes to 11%. And I think there's a number of issues here, Tumisang. One is that we are coming into this MPC with a global backdrop that is a lot riskier, where you have seen a lot of emerging market currencies, even with the rand, come under a fair bit of pressure. If you look at where the rand is today relative to the last MPC meeting, it's quite a bit weaker, which means that there's some imported inflation pressure that the South African Reserve Bank has to be concerned about. But we've also seen here that domestically, headline CPI inflation in the last sprint remaining at about 7%. We do know that the South African Reserve Bank wants to see inflation at about 4.5%. So we're still quite far away from that target. And another thing that we've seen, Tumisang, is that inflation expectations, which the South African Reserve Bank likes to monitor very closely, those have been going up. In the latest survey that we got from the Bureau of Economic Research, we've seen inflation expectations moving closer to about 6%. So all of those factors, are really what we believe, are forcing the Reserve Bank to keep this hawkish stance, and I think are likely to deliver another interest rate increase this afternoon.
Miyelani, from a perspective of economics and monetary policy, of course, it is justified that the central bank would be hiking rates once again, even at 25 basis points. But South African consumers are complaining, saying that there really isn't too much to give in terms of the rising cost of living and the pressures that we are facing as South African consumers. So how do we balance that scale?
Look, South Africans they're absolutely correct, right? We've got an economy that's under a lot of pressure from load shedding, and we're not performing as well as we should be, given that we're seeing an economy that isn't creating a lot of jobs. We've seen even from the QES survey that they put out that once you strip out the sort of usual seasonal gains that you see from retail, there really wasn't much that we saw in Q4. Price pressures have gone up, rates have gone up. So Africans have every right to be concerned about what's going on. But I think what we need to understand here in terms of what the South African Reserve Bank is doing is that, yes, a lot of the price pressures that we've seen come from things like energy costs, come from things like food prices, and there's always a question about, what is it that the South African Reserve Bank is actually trying to achieve by hiking interest rates when food prices are going up. And the point here is that the South African Reserve Bank is trying to avoid a situation where this inflation spreads out beyond food prices, beyond energy prices, into other goods and services in the economy, becoming embedded in a way that even when the food price pressures or the supply shocks go away, you remain with elevated inflationary pressures. So they're trying to contain the second-round effects of these shocks, because if you don't do that, you keep interest rates low, you're going to end up with much higher inflation for a much prolonged period, and that would be far more costly to the economy than having to live with the pain of higher interest rates in the short term.
Another matter that comes up when the Monetary Policy Committee meets is that of an economic growth forecast. We've heard from the World Bank, the IMF, and their projections are not looking good. And the last time we heard from the Central Bank Governor, Lesetja Kganyago, he had placed economic growth forecasts at 0.3%. This time around, where are we likely to be?
Yeah, I think it's going to be one of those key things in this MPC meeting. I think, this big variation, you're absolutely correct, Tumisang, there's big variation in forecast of growth this year. So you've got the Reserve Bank, 0.3%. You've got the National Treasury, I think about 0.9%. You've got the IMF, which is 0.1%. So virtually no growth. I think a lot of that divergence just reflects the fact that we don't really know how bad load shedding is going to get, how quickly it's going to ease. So that's really the big uncertainty around where growth is going to settle for this year. I think as far as the SARB is concerned, I'm not expecting that there's going to be a particularly big change in their growth forecast for this year. It's probably going to remain well below 1% for this year, Tumisang.
Lastly, Miyelani, economists and other analysts have indicated that we are slowly approaching maybe an end in the hiking cycle. Is that even still a possibility when we look at the remainder of 2023?
Yeah, it's a very important question, I think, for how we think about the evolution of monetary policy or interest rates from here. I should say that we as Absa, CIB, and a lot of our colleagues in the analyst community do expect that the hike or the increase that we're going to see this afternoon will be the last in this cycle, and we're not likely to see more. But we still are in this environment that I think is highly uncertain. So I think we'll have to pay very close attention to how the MPC assesses the balance of risks to the inflation outlook, to the growth outlook in the global environment, I think, to get a much better sense of where things are likely to go from here. But as our base case, we do believe that we are nearing the end of this hiking cycle as far as interest rates are concerned.
We cross fingers and toes. Thank you, as always, for your insights. Absa economist Miyelani Maluleke talking to us in that preview ahead of the outcomes of the Monetary Policy Committee meeting later today.